G'day everyone, welcome back to part 2 of our interview with Scott O'Neill. Like I said, the first half was absolute gold. Scott is super generous with his wisdom, his knowledge, and sharing his journey as well. So welcome to part 2 of our interview with Scott O'Neill. Buying the property is the strategy, and like I'm taking some action. You're like, well, hang on, we need to go back a step on what assets we're buying for what results. And people are like, just need to get into the market. And of course, we're proponents of getting to the market, but there's a sense of slowdown to speed up, which is let's articulate a strategy. I think you said before, because I speak to my broker, I'm like, but what does this property do for my next borrowing capacity? And having that level of foresight and diligence to go, if we do this, then this happens, for example, as well, versus a knee-jerk reaction going, this is a cracker deal, I'm just going to jump on this and not think about the consequences. How does a property strategy marry up with a loan strategy, I guess, overarching an investing strategy?
Yeah, and look, that's such a hard thing to do because the strategy depends on who's talking, who you spoke to that day. Like use the buyer's agent industry as an example. They've all got a different strategy. Some are buy high-yielding townhouses. Some are buying, blue chip assets. Some are buying like the middle ring suburb houses. And there's some great
Flips or another one, subdivision. You just keep going through the flavor of like, and it can be a rabbit hole. People going down these things, just going, oh, that's the one for me, and
exactly. And the worst thing, I get it, but everyone's got a different experience. Like you just got to pick someone who is in a position you want to be. So if you find someone who does the negative gearing route where they just refinance and live off equity, and if you think that's for you, follow that strategy. But just recognize the economy is different from when that person started as well, to give you unbiased advice. So if you think buying 50 houses in, lower socio-demographic places is for you, follow that strategy. But they're all going to give you very different outcomes, and that's very hard. And that's why I think the mortgage broker is a key part, because they can cross-check what the buyer's agent or even financial planners, they're generally not going to give you great property advice because they're there to ensure your situation. And it's hard to get good advice. You almost got to dumb it down and go who's in a position you want to be, and then take into the context of the current market what is different for them versus you, and then create your own plan and work backwards that way. But you just got to be a little bit careful just getting a plan from a company, and that's, you do need plans too, so you can't not have it. But it's always got to be a hybrid over your situation.
Stay in the course, and life gets in the way sometimes. People got the phone this week, someone, and it's a cancer scare, and it's like it just puts things into perspective sometimes. Like they actually double down on their investing. They're like, this has taught us now that we can't wait to take action. We've actually got to pull the trigger and go hard now. I was like, that contrary to what everyone else will be doing. They go, I'm going to pull back and we're going to focus on our health. They're like, actually, our wealth needs to become number one. If we're not income producing as people, how are we ever going to grow our wealth?
Yeah, it's a good point. Like even just 2 weeks ago, I had a client who's got some really bad health news, potentially terminal. And we're like, they're going to pull out of the contract. But no, they've doubled down because it's for their kids. So because they're building it's a commercial asset, it's a passive income. So he's, this person involved is thinking, look, it's helping me replace the income, so then they can live and doubling down. So you just got to do things for the next generation as well. And sometimes we run out of time, and that's one of the problems with a lot of these strategies on the market. They're too time consuming. That's why I went down the more high cash flow commercial route, because I didn't want to wait 30 years for things to double twice. And, in 30 years, I'm too old to enjoy it. So, I went the cash flow route because mysteriously I found that all these cash flow assets grew the same value, same percentage value within within a percent as the so-called blue chip assets as well. So, statistically, I was just benefiting from more income but getting similar growth. And that was one of the key points. Me getting 3 or 4% better as an internal rate of return over 10 years makes a big difference once it compounds on itself. And they're the little tweaks that make differences.
Cool. You've obviously seen the light with commercial, right? Very, very early on. So that maturity to go from residential to commercial is fraught with a lot of maybe misconceptions or fallacies around. I think one you said I can't get the capital growth on there. We've seen that, commercial does get strong capital growth. Tenant selection becomes critical as well to your success. The outgoings, covered by the tenant as well compared to, say, resi. But then the margin for error in terms of property selection, residential become a little bit more forgiving than commercial, which can be very unforgiving. You got the wrong tenant, for example, turnover, location. Like, take me through what are those potential pitfalls that catch out rookie, inexperienced, or the wrong type of commercial investor?
No, and there's a lot we can unpack here. So I'll just real quickly on one of the big myths, and that's the growth. So I wrote written 2 books. It was the second one, sort of an updated version of the first one. But what we did in the second one is I wanted to break down how much does this stuff really grow by, because you can't go into a Colliers or a CBRE or a Knight Frank report and get data for sub $10 million assets. They're reporting on the institutional grade, bigger ticket items, and they're generally controlled by fund managers. What fund managers often do is accept lower yields because I'm not saying all fund managers do, but the ones that are backed by super funds especially, they're just parking money up. They own half the towers in Sydney still. They just got to keep deploying money. So it's kind of a different market, but then it can go the other way where it crashes faster because when they're not buying and selling off each other, there's a lot less transactions, and that prices can fall faster. A GFC is a good example of that. So what we did is I commissioned a study into the square metre rates of every asset class in every capital city, and we looked at the building square metre rate. We took yield out of it, so we just looked at what a shed, let's say a secondary grade shed, sold in Western Sydney. We went back to 1995. That was the furthest we could go back data-wise, and then compared it to 2022 or 3. And we found the growth rate was exactly the same almost as residential, which kind of blew my mind because I always thought it was a lot less. There was literally a % difference between the highs and lows. And then I got thinking, it kind of makes sense that everything's growing at a similar rate because they're all attached to one thing, which is build costs. So there's another variable, which is land value as well. And if it's in a built-out suburb and you've got an industrial block next to a residential, one would argue that they will sort of keep similar values because if one goes way under, it'll get converted to residential, like Alexandria. Like if the value of industrial drops versus residential, there's a tipping point because there's a higher use for residential, which is multi-res, multi-story. So everything kind of evens out in the wash of things, and that's kind of it's economics, 101 stuff. But just seeing those numbers really just made me go, wow, I'm really getting similar growth. And fun fact, the fastest growing market in Australia anywhere is Western Sydney industrial. That outperformed basically any residential market because industrial's flying at the moment, and it kind of makes sense when you think about it. But if you spoke to someone in 1995, that industrial was kind of the ugliest, least preferred asset class. Office was the darling. Yeah. You had retail in the middle, and then industrial was like a third-class asset. Things changed. So office is now the third-class asset. Very general comment. There's some great office out there, but just interesting. And it's good to have these contexts because myths are one of the main reasons people don't go into this asset class. So we've debunked that myth, and but then you've got to realize the risks. And the risks are, if you get this wrong, you'll get punished. You are not going to get a tenant in 2 weeks' time. The vacancies are consolidated into big periods all at once. So residential, you might have vacancies every year. You might be 2 weeks vacancy, but then you've got to pay a rental manager 2 weeks letting fees. So effectively, you're getting 48 weeks a year of rent. When your industrial or office or retail tenant leaves, you might have 6 months vacancy. But you might have them for 10 years or 5 years. So there's less frequent vacancy. But when you're in the middle of that 4th month of vacancy, it's going to feel like the world's closed in on you, and it's pretty dire, and it takes a lot to get out of that if you're a first-time investor. You probably will never want to touch commercial again if you're unlucky to have your tenant leave at the wrong time. And luckily, there's some markets where vacancies get filled very quickly. But then you just need the right size business at the right time. So if you lose your retail tenant, I've lost many over the years, and some fill within a week, some take 6 months. It's just awkward because if you've got a 150 square meter retail spot, how many businesses are looking for that exact size?
That particular time.
There's very few. But then you get it and you might have them for 20 years. Like if you land a medical tenant, like think about where your local, the dentist you went as a kid, they're probably still there. You know, like I know the ones I went to, like in Miranda, they're all still there. Like they've probably been there 30, 40 years now. So if you land the right tenant, it could be there for the rest of your life as well. And that's the part of commercial I like. All the old supermarkets you used to shop at 40 years ago, most are still there.
They were called Bilo back then.
Yeah, the brands might change. Yeah, the ownership of these businesses will change, but the floor plate is still occupied by a business of similar nature. So even hairdressers, they generally keep occupying a spot, but the business changes because it's a hard business, and if you're a first-time business owner, you're probably not going to last, like statistically, there forever. Absolutely. But you're not going to just walk away from your fit-out and your lease and the goodwill the business has created. So you'll rather sell your business, which might have a multiple of 2 or 3 times the revenue. You don't walk away from that because it's a commodity. You try to sell your business, and as a commercial landlord, you benefit from the trading of businesses as well. Yeah. Just get a fresh set of eyes and ears, and hopefully they stay for a long time. So there's a lot more going on. That's kind of and that creates risk.
Yeah, and I think it's those potential little nuances that can catch commercial investors out. So the fit out, for example, due to a rent-free period, due to an abatement, for example, like what are you offering that's going to dangle the carrot to get the right tenant at the right time at the right price? And you're saying like trading businesses, but you don't want to have that turnover as well, and that site just going, that's not a high-performing location either. And it can be look, commercial, I can see it can be a blessing and a curse, but the right property at the right time with the right strategy can obviously lead to great results. Yeah,
you'll win and make more money in this commercial space, hands down, when you get it right, and you'll lose more when you get it wrong. It's simple. The risks and rewards are higher, so that's why most of our clients are experienced in whether they've owned a business or they've bought a number of houses and learnt on the way. But you need to eventually go for that higher return because the vanilla, homogenous residential portfolio does not work anymore. You can't retire off that efficiently. You can retire. It's going to take you a long time, and you just simply need to chase higher returns because interest rates are probably not going to go back down to 2%. So you're going to be sitting on these low-yielding assets. And one thing I do sort of fear with residential, which I've started talking about a bit more, is the political risk with it. A lot of people don't like, and we've expanded our business into New Zealand, and I've seen what political risk means for different countries, and things like not being able to claim your interest, or you've got minimum deposits of 40%, or there's you can't claim depreciation. We've seen it in Victoria, the land tax threshold's down to 50 grand, so everyone's selling their house because there's an extra 3 or 4 grand that is eating into their cash flow. The land tax rules are changing in New South Wales. Queensland was going to introduce this blended land tax calculation to include your properties in other states for their land tax calculation. So one thing you are going to see, there's a big prediction I've got, is there's going to be more have-nots in property. So we're in a political system where every 3 years the majority wins, and if the majority of people like an anti-housing policy because they're out of the picture, then that policy gets in. We saw it failed with Bill Shorten with capital gains, negative gearing. And we'll see more of this. We're seeing it at the state level, but I would not want to be sitting on dozens and dozens of low-yielding assets if they abolish that and it's not grandfathered out. So there's going to be risk there, and that's why I think diversity is important.
You're spot on, and we're looking at this all the time from our perspective. Like, property becomes such a political handball at the moment. Like you mentioned 3 states, Labor governments, for example. I'm certainly not going to get political, but it's an observation that we've got to factor in and go, at any point they can flick a pen and completely just upend someone's property strategy by introducing more land tax or changing thresholds, for example. And like again, to be nimble with your strategy, going, right, where's my exit and when's the right time to exit as well. Yeah. Mate, you mentioned a few things around, say, business owners. We're both business owners, for example. Bernie and I, we've got an episode coming up, which is called Business Owner Sweat Equity versus Property Equity. And if you look back at your journey, if you started your business, say 2015, versus buying property in 2015, this is not a pot shot at your business acumen. Would you have got the same results through your business versus the compound effect of property?
Well, yeah, it's a great question because I've been getting about as a return on equity in my portfolio. It's been around sort of 35% from day one. Yeah. So that's a combination of, call it 7% growth, then the yield, and then that leveraged component. If you do the math, that's kind of, it's like getting a 7% return on a 20% deposit, and then you take your mortgage out. And then we've had different mortgage rates over the years, so you can play around with that variable. But 30 odd % return compounding is a very good return. Correct. Equal to any active business strategy. Like there's some unicorn businesses out there that might have a 50% net margin, but most are less than that. You know, if you're selling something off the shelf, you're probably at 15 or less % margin. Developers work off 20% to 15%.
Hospitality far worse. Yeah,
they're about 5% these days. So yes, property can outperform it, and it's passive. So if you use your time to do other things, then that's kind of an opportunity that goes on top of those returns as well. So it depends how you look at it. You can potentially scale business faster. Like if you're in the right industry, yes, you will. It's not potentially, you will scale faster because it's greenfield stuff. So if you've created a new product that sweeps the world by storm, that's a different ball game. But yeah, if you're just going into an old industry and doing what everyone else is doing, margins are generally going to be quite similar, if not less than an active business return, property return. But the problem with property returns is a lot of it comes from equity, not cash flow. So that 35% return I'm mentioning I got on equity, a lot of it's trapped as equity.
Yeah.
So cash flow is definitely not that high. So that's a problem as well because you've got to sell, pay capital gains tax or refinance, and then your money's debt essentially. So there's a lot you can look at that.
Yeah, I guess when I look at some like smaller business owners, I'm like, geez, mate, if you just bought property, you've been in the business for 7 years, and they're not pulling big numbers out with profit. I was like, mate, if you just bought a property 7 years ago, you would have made far more money. And I guess the perspective I've got there is we're such a heavily stacked property country over business as well. And you talk about some of the taxes they're introducing. Or was it Victoria's introduced like 20 odd new taxes, to property investors. So, but I feel like business owners, backbone of this country, but they're not getting that level of return on where they would have through property. And I feel like we're such a property fueled country over a business fueled country as well sometimes.
Yeah, 100%. It's almost like the difference with China and the US economies, isn't it? Yeah. China's very property focused. Like, what is it? 30 odd % of GDP. Don't quote me. It's like literally it's deep down in the memory bank there. But it's that's why it's so political in Australia, and that's why there is a risk there, because if policy changes from being more, business or more socialist, then you're going to see things a little bit worse moving forward, because there's a lot keeping the train going. But if common sense comes into it, and this is potentially controversial as well, is like you need property to do well for the greater good. Yes, there's going to be people miss out on getting on that train, but if property investors are not supplying rentals to the market, it's the government, and you don't want to be living out of the government's pocket. Like that's a very uninspiring way to live. But there's, if you've got the option to not do that, great. If that's your only option, then we're in a very lucky country to hopefully support you better than some of the others around the world. So, I think what we've got, it's a good mix, but it could always be better.
Yeah, nice one. I want to touch on the buyer's agency industry as a whole, and we've had plenty of really, really, really good buyer's agents. When I reflect on the names that have come through on this podcast, probably on yours, what you've seen in the industry, there's some, like you said, high quality, high caliber players there as well. almost like a bit of a bell curve though. You got mid pack, and then you got some lower performing ones as well. Looking back on the buyers agency industry and how it's evolved and starting to find its feet as well, what are your observations at the moment?
So it's new industry. So I kind of liken it to the real estate industry maybe 100 years ago.
Yeah.
So
Okay.
sales. So what I predict will happen with the industry is there'll be more larger companies form, because I'm seeing it with my own business. We've hired a fair few people that own they own residential buyers agencies and did commercial, but they're finding it harder and harder to do it on their own because the competition's increasing. So the nature of the industry is more people fighting over the same patch. I'll quote one of the guys I was speaking with. He's like, I was trying to buy a property in Perth, and the agent said there's 50 other buyers agents on his list, all wanting that off-market deal. So it's now getting hard. So yes, it's not like starting 10 years ago. There's going to be a lot more people wanting the same thing. So what that means with most industries is the little ones may start dying off or becoming absorbed by the larger ones. So there'll be less but larger companies, similar to the real estate industry where you got your Ray Whites, those types of businesses. But there'll always be the area specialists and all that kind of stuff. So that's just a prediction. It's not that groundbreaking, but really I think it'll get harder because there's just so many people all wanting the same thing, and they see those kind of outliers and they all want to be that. They jump in it. There's a lot of courses out there helping people be buyers agents. Some are suitable, some are not. You've got to be incredibly good at sales. It's a lot more time consuming than people think as well. So yeah, but competition's good. It needed it. It means the poor ones will just get weeded out and the good ones will get larger and larger.
Yeah, nice. Do you feel it's moving to like a American style model where you've got I think they call them like vendors or buyers advocates, for example, over there, or a buyer broker. And so we moved to that model where the adoption of using a buyer's agent, because I feel like Sydney gets it, heaps of stuff happens, and then the off markets as well, we'll come to in a second. But are we moving to evolving to a slightly similar-ish model, you reckon?
It'll be very different. So their buyers agents are different to ours. So they've got this strategy over there where there's a 6% commission. It's kind of set.
Yeah.
It's not set, but it's set. And it's kind of, there's a realtor group over there that's kind of got a big monopoly over there that kind of controls who gets listings. And it's very, very complicated. I'm not fully across it, but essentially they split the 6%. So the buyers, and they're not buyers agents, they're just selling agents that kind of act as a buyer's agent. I've introduced you the buyer, I get 3%, you get 3%. Okay. There's a lot more costs involved for their businesses with that, but they're not truly acting as a buyer's agent. It's a weird setup, to be honest. I don't understand it because I've looked at, do I expand my business into the US, and it's so different from the strategies we have in Australia. Like we're really kind of like a stockbroker. A wealth creator. They're just sales agents a lot of the time. And I'm generalizing here, but the ones you see on $1 Million listing, they're acting as a buyer. One of the famous guys who's always selling properties is them helping someone buy a property. They're negotiating against their mate who's the sales agent. Yeah, it's a strange setup, but we're just pure that, and not both sides, but. Yeah, I see it in places like New Zealand. They kind of do a bit of both as well. Like in the parts of Europe, similar. So I think Australia's more unique. We're very pure buyers agents.
One side, buyer or seller side. Yeah, cool. Thanks very much, mate. You spoke about Rethink and how it's evolved. Started with you probably on a laptop all those years ago, and now it's evolved into. You said I think you're touching on 21 as a team. That then has its own kind of ramifications around scale, around growth, around where your time goes and your energy goes as well. So take us through what are you focusing on at the moment, and where is Rethink kind of headed? Yeah,
so when we started nearly a decade ago, it was just myself, then the wife jumped on board, and there was
always the best first recruit.
Yeah. I was like, it's cheaper than getting a PA type of thing, and but it was good, and that kind of helped align goals too. Yeah, very tough working with your partner as a small business too. Yeah. So it was.
It changes your relationship, doesn't it?
Yeah, we are talking work, and it becomes you just need the gap, you know. So like I'd work in a cafe one day, like because we're literally on a 1.2 meter radius coffee table, you know, next to each other, and like it was that full on. And then everything. There's no part of your day that's unknown, and that's kind of we've worked through that, and that's been great. So we're stronger as a relationship for those early days, and but yeah, once we started hiring it, that's where things kind of grew, and we were an early adopter into the buyer's agent industry, so we grew quick. There was only probably one or two other buyer's agents that were doing the volumes we were doing in those kind of 2017 year types, and now it's a very different market, and it's a lot more competitive. I moved into commercial, and that's where it got tricky from a business point of view, because it's not like you just have someone that does sales, someone finding properties, and some admin in the team. Like you need a very high class due diligence team. You need people managing the settlement process, which can involve 20 extra steps. Like, because you've got to, like, we're expanding into New Zealand at the moment. You need an earthquake specialist. You need all these contractors at the right time, and you've got to have quick people to call upon when things go wrong. You buy refrigerated warehouses, you need to have those people. You need to review reports that are more at an engineered level rather than there's a termite problem, you know, there's a crack in the wall. Like these things are, they're full on maintenance schedules.
Stakes get a lot higher, don't they? Yeah.
And you've got to understand how long that equipment will last, what's the replacement value. So the team just got bigger, the risks were much higher, and it was kind of enjoyable working with that higher risk too, because we leveled up as well. That's why we find residential property buying so simple compared to it, and that's why there's a lot of people. You watch, there'll be a lot of people get into commercial and they'll look at it, they'll do a few smaller deals and they'll go, it's not worth it, because it's not. You need to do volume, and you need to do the larger deals to justify it, because we lose money on our entry level prices. Like there's no secret about that, but you need to do those deals to get access to people that have the high net worth. It's just like playing the field. You don't just only want to work.
Well, I mean, they might start there, but they might actually scale up, and you want to be on that journey with them as well.
Exactly, and we've had so many clients do that. You buy 3 or 4, 500 grand warehouses, and then they've doubled in value, and then bang, you've got that 1.5 mil equity. Take out 70% of that. That's a good deposit for a small shopping centre. So the journey gets really good, and then they might sell off residential and then transition to a higher percentage of commercial ownership, and so it's really levelling up. We're up to about sort of, I'd say, I know the Christmas party we did numbers 134 people coming, and there'd be about 40 partners in that. So there's the business is sort of that 80, 90 now, and it's starting to get a little bit easier again. The hardest point was that 10 to 30 staff, because you're still the direct manager of all of them, and that's very time consuming. So HR is the thing that eats away, because there's always someone unhappy, whether it's they're not getting enough leads, or the properties aren't flowing as enough, or there's a few tough deals in a row. Like someone wants something that we can't offer yet. Like that, you're really in that kind of frontline management of it. But once you get that next stage, it starts getting a bit more corporate and more enjoyable.
Well, it's a bit like your property portfolio, right? Managing a handful of properties, everything becomes, I guess, things are popping up when there's problems. And you're like, when am I actually going to enjoy this? I had a client go, you said this was passive income, and all I feel like I'm doing is managing this thing. I'm like, it's going to get to a point where they just become another day at the office with issues around properties and tenants and managing your stakeholders such as banks and property managers. But it's par for the course. And I think there's a level of resilience that happens as a property investor, and who can kind of hold their nerve to get through this tipping point. And then the same thing happens with business, whereas like you can be in this real middle shaky ground. It's like, do you retreat and go back to a real sweet spot, or do you push through and go into like this land that very few business owners like you can get to?
Yeah, and I had that moment. I was like, really considering, do I just scale back and just deal with like just my choice of like a handful of people per month, and it would have been very easy. Profit would have been great. Like there'd be no complaints there. But I went the other way, and it's you still think, it would be good to have the less time and that kind of stuff. But like it's a big choice to make, and everyone's going to have their own. Like if there's other buyers agents listening, everyone's going to have their own comfort zone and where they're best to operate. Some people may not have the management capabilities of dealing with a 100-man team or a 100-person team, should I say? So or you don't want to, because it's a lifestyle choice. Like you're corporate again. You know, a lot of people choose investing to get away from that, and then the small teams can be a lot more. You can be much closer with your staff, and you're a lot more kind of it's more fun and games potentially as well. Less client spend, you can pick and choose as well, like instead of working with everyone. So it's a really interesting one that. But I feel like for myself, we've been able to help more people. I know this product works. We've got the system in place. We've done, up to today, it's 4.65 billion in transactions, and we've walked away from about another half a billion in property as well. So we've seen so much go right, so much go wrong, still getting better every day. And that's one of the advice as well for clients. Like, nothing against new starters, but I just know from my journey, the buyer's agent I was year one versus now, it's chalk and cheese because of just so much water under the bridge. And I know I've just seen volume of things happen, and you know how to fix things now. And like when things go wrong, there's a solution. Like, and it's a mindset. This is back to the investor. Like you said, like you got to have that mindset. If things go wrong, you got to think, how do I fix it? You don't go, I give up. You know, you get down. You will get down, but you got to have that entrepreneurial spirit as an investor to keep thinking day or night, how do I fix it? And that's particularly important with commercial, because if your property goes vacant, and let's say it was a specialist fit out, and you've checked with the fit out, that no other specialist in that industry wants your property, what do? You've got to start talking to architects. You've got to wait for the market to turn. You've got to split the property up. Like it's going to cost you more time and money. And there's a way to not enjoy it, but just go along with it, just like in business, to get the best outcome. And whenever that happens, you have a good celebration day because you've got through something that others wouldn't have.
Yeah, it's a great perspective. And I look at where you are on your journey, and it's almost like this a want to help people, because you're like, again, you could retreat and that'd be great for you. But then you go, all these investors that are capable of building these incredible portfolios, build intergenerational wealth, change the lives of them and their families, change the lives of the team, and this ripple effect has gotten bigger. And it's like, we need a Scott O'Neill to have some balls of steel, for example, to go to this, to this place, because other people are going to be the beneficiaries of it. Whereas when you retreat, this gift isn't shared with a lot of people. Yeah. Yeah.
Yeah. And that's probably the thing I get most enjoyment out of. It's one, I like kind of helping more and more people. And the other side's hiring people. Like, I'd say
your talent pool. I mean,
and a lot of them
need is shrink. Yeah. Sorry.
So a lot of our guys are, and these are the people talking to a lot of our new leads, our clients that have built, massive portfolios, like 30, 40 million plus. And a lot of them they chose the more private route where they don't want to talk about what they've got. But some of the guys working for me are incredibly wealthy, and they don't need the money. They choose to do it, and it's just skin in the game, like you mentioned. Like, it keeps you in touch with the property market. And what else do? You go back to corporate or sit on a beach. Like, I think they're two extremes that can both lead to unhappiness. So if you can choose some kind of role where you can, like a hybrid role where you can help people, use your knowledge, because these guys have done it. They've retired, and that's one of the biggest strengths of Rethink Investing, I think. It's the people working there. They're not just your average people. They're generally investors, and some are significant in what they've done as well, and still going as well. So that, like, they know how to deal with problems when they come up. They know how to deal with a doubt or a concern a client has, rather than just a churn and burn model.
I mean, you got your podcast. Is it weird being on the other side?
Yeah. Oh no. Look, you talk about different things. Like our podcast, I don't really talk about the business or things like that.
Yeah.
Besides an odd comment here. So no, it's definitely more. more prying in a good way. It allows you to say different things. So no, I've said a lot on this podcast I've never said anywhere. So
thanks, man.
That's
I
good.
really appreciate you. Like I said, I feel like you're an open book without beating your chest. And it's a very fine line to walk, which is, hey, look what we're doing, not look what I'm doing. And when you put the spotlight on the business or the performance that you've had as a portfolio and not tickets on yourself, it's very hard to manage that. But I think you do it exceptionally well, mate. So kudos to yourself and your family. I feel like there's some really good family values and traits that come out here especially when you're raising young kids and you go, mate, we've made these harder decisions in our 20s and now we're in our 30s, but you can become the beneficiaries of that, but also in your life as well, your team. So take us through, you mentioned the book has gone into its second iteration, for example, as well. So what changed from the first time it got released to now?
Yeah, good question. So from memory, we released the first book when COVID was around, so super low rates. So that I think I had it in print, all these like low rates, and I was like, I can't leave that as an evergreen source. So that was the initial thought. I want to make it more up to date with the current interest rates and talk about, like, I guess we'd done another billions in extra purchases between, so I learned a lot more. So I think the first book was just a quick, easy, simple introduction to commercial property through real world experience, and that was the most important thing. Like, it's the number one in terms of book volume in commercial. Like, I think it's sold, according to Wiley Publishing, like 6 times the volume of the next one, and it's about kind of 8th or 9th in Australia's volume. So a lot of people have read it, and it can. In my mind, it was too junior as well. And even the last book we did still kind of written simply, like it doesn't match what the business does. But I wanted to keep the book light because it's through the lens, and we disclose properties I've personally bought with my wife and clients. So like real world stuff, because that's what's more relatable than just lining out stats and what square meter rate means and all that. Like, we've got to show real examples because you learn by doing. That's how I learned. I've done plenty of uni, and I've really struggled with the concept of theoretical learning because I learned more on the first 2 weeks of my job as an engineer than I did in 4 years of doing it. So you've got to like see how it works with real deals. So we've got an education course as well. So the education, like the feedback with that course, we ask them what is the best part of it. They said, Scott, your deal reviews are the best because like it's like a Zoom recording, and I'll go through a real deal we bought for a client or one we crashed for whatever reason. Explain first of all how we found the deal, what we liked about it, what separated it from all the others at the time, how we analysed the upside, how we ran into problems during due diligence, how we negotiated through that or how we didn't, how we got through a difficult situation with a vendor not understanding our concepts as well. Like, all this stuff is how you learn. Like, you go through 10 of those, you're going to know more than reading 200 pages of theory, I think, because the theory, you can get gazumped day one if you're not practicing. And that's what I found with engineering. There's like some brilliant minds that do engineering, but if they don't know how to go on site and deal with a bunch of angry trades, and they want to build a conduit, under some tracks, like the theory doesn't matter. Fluid dynamics don't matter. So it's a learning by doing. So that's what the book sort of really highlights, just real world stuff, and people have seemed like they've enjoyed it.
Cool. What's on the horizon next for you personally, professionally, property wise? Like, what happens to the Scott O'Neill story next?
Good question. Like, I sort of don't have huge long-term plans, to be honest. Like, it's just moving forward is the key. So wanted better last year, the year before every year. So that's the main thing. I don't look towards doing anything other than improving the business, the experience for customers. I'm not as focused on my own portfolio now. That's one thing I must admit. I feel like the critical mass is there, and we're at a point where it's creating more work for us if we buy properties. I will buy more. Like, I'll probably buy one in New Zealand just because I want to, learn by doing over there as well. We're helping clients. We're helping New Zealanders buy in New Zealand, and that's that business is only a month old and it's going pretty good as well. So just want to be an Australian purchasing there as well, because there's all these different rules, and it's a diversity play as well. Again, if politics get really ugly, you still got that over there as something that won't be affected by it. But yeah, just continual growth, a little bit more focus on the business rather than my own portfolio. And yeah, there's a few more businesses we'll launch in the next couple of years. We're doing the vertical integration model because we've got such a niche business. We find the businesses outside of our sphere struggle a bit. So like the legal firms we used to use, they're used to dealing with residential, or there are a fund manager type lawyer, and they charge 20 grand, for a transaction. So we needed someone in between. So we're the in between. And same goes with building reports. Like a lot of the residential guys, they get to a shopping centre and spend 3 days there, and charge you 6 grand for a report. So you've got to have your specialist in each department. So just connecting that gap, that vertical integration model for the client's benefits, just an ongoing process.
Yeah, that's exciting, mate. Yeah. And watch with, from the sidelines, very exciting to see, what you've done in kind of a relatively short time period with property and with business, and now next stage of family. Happiness is part of the equation as well. Like, where does that kind of fit in, and enjoyment?
Oh, that's huge. Yeah. Like, one thing I did this year is just parts of my job, what doesn't make me happy working. And things like being too busy was one of them. Like, because you think about when you're having a busy day, you start becoming short with people. You're not putting the thoughts into it. You're less creative. Yeah. So just trying to get time back is so important. So that if you don't have time, you're not going to be happy generally. You're just going to be chasing your tail. And yeah, we've got a good work balance with the whole living in Europe thing in summer. It's going to get harder now. We're, first kids coming to school age next year. So we'll, I don't know, we'll have to work out what to do there. But shorter holidays is going to be a thing. But balance is key. I think there's no point just chasing revenue to the nth degree. What's the point? It's not going to change your life anymore. You're just going to create more work, and then that creates the unhappy feeling beyond that. So, yeah.
Cool, mate. Someone's listening, ideal type of client that you guys work with, take us through.
So for the residential guys, like anyone that's got kind of 50, 100 grand minimum deposit, like all the usual stuff, we invest for value, where we've got the track record of investing for a decade and just know how to sort of seek out value. So we want to get the type of person that wants to work with us for the journey. So once-off transactions, again, like as a company, we've got a lot more overheads than others because we've got, dozens and dozens of extra more people than most companies. So we really want to be able to kind of work with them for the journey and get them to commercial. So you buy the residential properties, then they're going to build equity. And then we're not just going to keep going, we'll keep buying, because that's a doomed strategy with the current climate. So we'll get them into a different asset class. We're even investing in, like I said, New Zealand. So some of our commercial guys have bought 10 commercial properties. So we've got industrial, we've got, diversity through retail, and even sort of suburban office. So maybe different country type stuff is the next. So yeah, big, diverse, profitable portfolios is what we create. And yeah, we are specialists in the high net worth space. So we're probably the only buyer's agency that I know of in the country that regularly works with 10 mil plus deals, and that's where we do our best work, because we can negotiate from a third party point of view where we don't care if the deal goes ahead or not. And that, I can give you countless examples. We'll always get that last 200 grand discount on the price. We'll always get the off-market deal that no one's seen, because it's 90% off-market in that space. So our connections are kind of what you pay for, just getting access to off-market deals, and to the point where fund managers use us, even though that's their game and they're the best investors, because they might have billions under management, but they're not doing the amount of transactions we do. So our connections through doing 40 plus deals a month means we've got more touch points with more agents, more owners direct. And that's a time saver, basically.
That's incredible, mate. Well done. I want to say thank you so much. You've been so generous with your time, with your energy, your knowledge. This is what it's about. So if you're listening and you've loved this episode, like I say, don't worry about the reviews or the stars or whatever it comes with it. Share this with a friend, because I feel like someone on the journey that wants to, level up themselves personally, professionally from a property investing perspective needs to be surrounding themselves with good quality people, good quality content as well. But I think we'll go back to the very start. It's the strategy and the clarity that comes with that. What are you doing? Why are you doing it? And who you're trusting as well becomes imperative for success. And I think your journey is a real testament to that. So, mate, big ups. Thank you so much. Appreciate it.
Thank you,
We'll
Aaron.
watch this space with
It's been a
excitement. Like I said, if you love this episode, share it, but also give us the feedback. We are getting so much great feedback that comes from people saying they're really enjoying particularly some content as well. And we'll look forward to bringing the next episode of the Australian Property Investment Podcast very soon. Thanks.